Welcome to another weekly portfolio update here on The Last Investor. My name is Dan. I'm going to give you an update on how my portfolio has performed over this past week, and right at the end I'll discuss the 6 categories according to Peter Lynch that all stocks fall into and how this could define the risk profile of each of our portfolios. But first, if you're new to this channel, thanks for taking the time out to join me. Please subscribe to the channel, and if you like the content, please leave a comment and like the video. And a big thank you again to all those who have already subscribed. I would love to get to 100 subscribers, so any effort in that direction is much appreciated. Okay, so let's get straight to the portfolio update. So this week overall, my portfolio is down by around £51.86, which is roughly 0.56% of my overall portfolio. As for my individual stocks, Crispr Therapeutics in the last 7 days is up roughly around 3%. I saw a brilliant interview carried out by Cathie Wood of ARK Invest. She interviewed a lady called Jennifer Doudna, who's the co-founder of CRISPR-Cas9, the gene editing technology. And during that interview, Jennifer Doudna basically broke down how she came about in discovering this CRISPR-Cas9 technology and its usefulness. And what she also did was discuss the very first patient who volunteered to undergo treatment using this new CRISPR-Cas9 drug. Her name is Victoria Gray. This just highlights how significant an impact this drug could be for the future and how this could really disrupt the biopharmaceutical industry by a significant margin. Because if this drug carries on the current trajectory, then it's very likely that it will be something that's going to be used as a worldwide standard for curing sickle cell diseases, which is really quite significant. That is why I remain bullish on the CRISPR-Cas9 technology and the progress that's currently being made. And then my next stock is Rio Tinto. That is currently up about 0.5%. Not much news there. Centamin, that is in the last 7 days up 1.2%. Then we have 3i. This is up about 2.5% in the last 7 days. We went down but went back up again, as can be seen there. They've maintained their plan to pay a dividend despite being hit hard by COVID-19, so that would have been quite encouraging for shareholders. Then Trig, in the last 7 days, it's gone down a bit, about 1.55% down. Then next, I've got Carnival Corp, and in the last 7 days, that's gone down a whopping 16%. So this is the black swan in my portfolio for sure, and it's proven to be a real black swan. I mean, the troubles and woes just keep rolling in for Carnival Corp. It's also recently been downgraded to junk status by S&P Standard & Poor, the rating agency. It's also selling about 6 of its ships from its 100-ship fleet, and apparently they're going to be scrapping quite a few of them, not just selling them, they're going to be scrapping them, which means they would not be getting any money back for them. I think the risk of Carnival Corp going under is getting more and more real as the day goes by, and it's really quite worrying. But we just have to see how this plays out. I'm going to carry on holding it for the time being and see how the news plays out. But of course, it's definitely a risky stock at this point in time. If anyone was thinking about going into it at this stage with all of the bad news, there are better places to invest your money. That's all I'll say about that. And next we have Greatland Enviro. That's in the last 7 days down 0.7%. And then we have Greatland Gold. In the last 7 days, Greatland Gold has been down roughly about 1%, but I'm still up huge on this, over 111% up on the share, so I can't complain too much. PagerDuty in the last 7 days is down about 9%. Crest Nicholson, another company that seems to be taking a major hit at the moment, in the last 7 days is down about 16% for me. And really, Crest Nicholson and Carnival Corp are the two stocks in my portfolio which are down by at least 50%, which is really significant. But enough about that. Now let's talk about the stocks I've just recently purchased. So in last week, I've purchased 3 new stocks in the genomics sector. Invitae is the first one. And Invitae is a company that provides genetic testing services. And when you think about how the gene editing industry is growing, I think genetic testing is only going to benefit from that, because the more sophisticated gene editing gets and the more development happen in that area, then more people are more likely going to be requiring genetics testing. So I could see those two sectors of genomics in general growing in lockstep. So that's something I look forward to. So I'm going to be gradually building my position in Invitae. They're still quite expensive stocks at the moment, but overall, once that industry grows, the likelihood is that we'll see some value in there as well. And the next one that I also purchased is Intellia. Intellia is actually a gene editing company, and again, I purchased not that much shares. I purchased £100 worth of shares in that. And I think, again, like Crispr Therapeutics, once those gene editing become more sophisticated and they start to expand their portfolio of gene editing areas, and we can see some growth there as well. And finally, F.A.C.T.S.S is the third of that trio of gene editing companies. And again, I'm really excited about having F.A.C.T.S.S on there. I think F.A.C.T.S is pretty much the dark horse amongst all three, and I think they probably have the potential for seeing real huge growth going forward. So I'm keeping an eye on that, and again, I'll be purchasing small shares going forward to try and build up my position in that, probably to build it up close to about £1,000, which is what I've got at the moment for Crispr Therapeutics. So I'm really excited about that. I'll keep an eye out for that. I'll be talking about those a little bit later as well. I also purchased Illumina, and Illumina is a different type of genomics company, because what it does is that it actually produces the equipment that helps gene editing companies and gene mapping companies to do their job. So that is really another industry which I could see growing in lockstep with the rest of the genomics industry. So a huge potential for growth here as well. That's why I purchased that. Again, another company which is a little bit expensive, and that's why in this particular case I've only just purchased about £10 worth of shares, and I'm going to try and grow that even more gradually. Hopefully it will drop in price at some point, and I'll go big and purchase a larger sum if it really drops down in price. But for the time being, I think it really is quite expensive. Then another stock that I really like is Teladoc, and Teladoc it's almost like a virtual healthcare, so they deliver services over videos and telephones, and I suspect this is going to be the future going forward, especially now with COVID-19. I think people would want to be accessing services in this way, and so yeah, I'll be building my position in this one very gradually. Again, very expensive stock, but actually long term it most likely will produce some value. So yes, I'll be purchasing some more of that. And then I also purchased Greencoat, which is another renewable energy company, just to add to that portfolio of renewable energy going forward. It's my play against big oil, so that's why I keep buying these renewable energy companies. I just think that in the long term, as oil begins to decline, then you'll see a growth in renewable energy companies. So that's why I've got that in there. So there we are. That's my portfolio update for today. So now let's talk about Peter Lynch. Peter Lynch is a private equity fund manager, and he ran the Magellan Fund, which was famous for outperforming the S&P 500 and averaged almost 30% per year between 1977 to 1990 consistently. That is crazy growth. I mean, it pretty much rivaled Warren Buffett in terms of his ability to just buy fantastic companies and have returns year after year. He also wrote a book which is called One Up on Wall Street. And if you don't know Peter Lynch, and if you're looking for a book to read about investing and value investing, dividend investing, you would do no better than picking up this book. I mean, I've read it, but I read the book 3 times at the very least, and probably because I'm quite slow on the uptake, but it's also because it's a fantastic book. So I would definitely recommend that book to you. So in that book, he talks about the 6 main categories that every single company should fall into. And when you're looking at companies, you should be thinking very carefully about which of these categories they fall into, because that would have some implications as to how the companies is probably likely to behave. So he's categorized them as fast growers, asset plays, cyclicals, turnarounds, stalwarts, and slow growers. Basically, the acronym there will be FACT, I guess, isn't it? FACT, but there we are. So the idea is that you should have a mix of these types of companies in your portfolio, but the important point is to understand when it's best to buy each of these types of companies and understand the benefits and drawbacks for each of them so that you can avoid getting really stuck. So fast growers, these mostly include stocks of small-sized firms growing at an aggressive pace of between, let's say, 20-25% a year. They can generate huge returns and even become multi-baggers within a relatively short span of time. However, they also carry a considerable higher risk because they're obviously small in nature and they could go the other direction and go bust. I don't have any fast-growing stocks in my portfolio, but a few stocks that I own, which I will touch upon later, may hopefully turn into fast growers. That's certainly what I hope, but they're probably better categorized as asset plays, and I would explain that a little bit later. There are stocks like Editas and Intelia, which we've talked about, and of course they don't have that revenue stream at present, but once they begin to produce, they could become real fast growers. They're small caps, so they fit into that category on the basis they're small caps at the moment, and that really lends its hand to that real potential growth. Because if you think about it, if you have a company that's 1 billion, it can easily double to 2 billion. When you compare it to a company that has 100 billion market cap, it's much more difficult to double and go up to 200 billion. So that's why small cap companies tend to be more likely to grow faster and tend to be fast growing companies. Then the next one is asset play. These are stocks of companies that own key assets which sets themselves apart from other companies but are mostly overlooked by the market. The firm may have a huge cash reserve that might come in handy during a downturn, or may own large real estate that has not been valued properly. However, finding these assets and assessing their value requires good knowledge of the company that owns the assets. So in my portfolio, a lot of stocks in my portfolio will fall into the category for different reasons. I will describe a few of the biopharmaceutical companies as asset plays. So Crispr Therapeutics, Editas, Lumina, in my view, I'll put them down as an asset play as far as I'm concerned, because I don't think that the mainstream fully appreciate the potential that these companies have, especially the industry itself, and only a few players are leading the way in this field as well. So there's 3 of them, and they're the only ones leading the way. So whilst CRISPR might be the proverbial digger that digs up the gene editing stuff, the Illumina is effectively the proverbial shovel because they provide all the instruments to these other companies. So again, they also have that potential for growth as well. So that's why I put them as an asset play. Then you have the gold mining stocks like Centamin and Greatland Gold. And for me, they are also asset plays because it's almost like a hedge against turbulent times. And so they act in a slightly different way to other stocks. And so for me, I use that in that way because of that attribute that they have of being almost recession proof, and so they can maintain my portfolio during very uncertain times. And then finally, I've got the renewable stocks like Trig, JLen, Bluefield, and Greencoat. And these are my bet against big oil, as I said earlier on, because over time, as big oil starts to decline in value, I'm talking about 10 years' time or in 20 years' time, I expect these companies to start flourishing and to be more established, and they would have grown into the industry, and as the industry becomes wider. So, and they also pay a very handsome dividend as well. So that is what I'm banking on. And again, that's why I look at those as asset play stocks for me. Then we have cyclicals, and companies in this stock basket tend to exhibit inconsistency in revenue growth. They're likely to perform in line with the broader economy or industry or the industrial cycle in quite predictable pattern. Actually, the earnings growth can vary from about 5 to 6% during downturns or 18 to 20% during upturns. And the stock prices also move erratically based on the stage of the economic cycle that the company is currently going through. So companies like automobile, construction, metals, industrials, banking sector, these are all prime examples of cyclicals. So understanding where we are in the economic cycle is actually very relevant when considering buying a cyclical company. So for my portfolio, Rio Tinto and BHP are good examples of cyclical companies. So it's better to buy them during a downturn and sell them at the top of the booming market. So that's what it's worth taking into account. Then turnarounds. This includes stocks that have been badly hammered in the market for a variety of reasons, but they're in a position to rebound very quickly, and then the share price can then spike if a new company makes a strategic investment or they take on a new leader. If you're able to identify a turnaround stock at the right time, you could make outsized returns within a very short span of time. Although these stocks have the potential for huge gains, the risk is real. The risk is real with them because they could literally go bust. And that's why they're called turnarounds, because they're heading in the wrong direction and they could potentially turn around and head in the right direction. But if they don't turn around, then they're a disaster. So for my portfolio, you probably guessed which stock of mine is a potential turnaround, and yes, it's Carnival Cruise. And really, this stock is heading in the wrong direction right now. And if you were one of those people that purchased Carnival Cruise, maybe when it was around £8 a share, just after it'd been really beat down, then you're probably not doing too badly, because obviously it's sitting around the £9 a share range, but it looks like it's going to be heading back towards £8 a share, and possibly even lower. Who knows? If the bad news keeps coming in, as they just keep rolling in at the moment, though, just keep rolling in is bad news. So really, if things go well and they get out of this COVID-19 situation, then I really do have high hopes for them going forward. All they need is to get that revenue stream back on and running. But if they don't get that revenue stream back up and running, the risk is right on for them going off, never coming back. So that's my turnaround. But if they do turn around, then I see it going in the right direction, and that could be a huge gain very quickly. Another obvious example of a turnaround would be Boeing. Boeing is going through its craziness at the moment. I think they've just had the news that they've got the approval for them to start manufacturing the 737s. So we'll see where that goes. I think that there was a little bit of a spike in the share price as well recently as well as a result of that news breaking earlier this week. So although Carnival Corp carries a far greater risk now than Boeing does, I think Boeing is probably the better play, certainly because it's not quite as risky as Carnival currently is. Stalwarts, this category also includes stocks of large companies, but they're able to grow at a fairly fast clip, say between 10 and 15% earnings growth. They're able to maintain a decent earnings growth even during downturns, mostly due to the nature of their offerings. So you've got companies in the fast-moving consumer goods sector, such as McDonald's and Coca-Cola, and big pharmaceutical companies like Pfizer and GlaxoSmithKline. These are all real examples of stalwarts because, to be honest, they're not really going anywhere anytime soon, and their prices are not generally affected that much because no matter what, people are always going to be using their products. So I don't really have any stalwarts in my portfolio. They're just way too expensive, and for what they are, it's not really worth me having them. I think one of the things I don't really like about stalwarts, especially stocks like McDonald's and Coca-Cola, is that the fundamentals from a balance sheet perspective, I don't really like what I see when I look at their balance sheets. Look, they're not going anywhere. I understand that, I get it, but it only takes something that you don't see now for it to change, because that was one of the reasons why I took on Carnival Corp in the first place, because Carnival Corp effectively would have been a stalwart, and because it was effectively a cash machine. It's been generating money for years on end, and I just thought, well, I just overlooked the balance sheet. His balance sheet was even better than what Coca-Cola's balance sheet was, better than what Boeing's balance sheet is at the moment, or was even before we had this crisis. And look at what happened to Carnival Corp, and look at how much of a mess they're in. So for me, my focus is on balance sheet more so than the fact that it's a cash machine or a cash generating machine. I'd rather have that balance sheet first in place, and look at that and then build from there. But I don't really see anything out there. All of these cash machines, I call them, but all these stalwart companies, their balance sheets don't look good and they don't impress me at all. That's why I stay away from them. Then we have slow growers. They're not expected to grow faster than the overall economy. They rarely yield a big return on investment, but they're also known to provide regular and hefty dividends. This is because they have almost always reached their full maturity as a company and therefore less room to grow. Examples of this would be utilities. And in my portfolio, I think Aviva is a slow grower, and I really like Aviva, and I guess I would put Legal & General in that category. I really love these companies. They're not going anywhere. The business isn't going anywhere. They also have their risks. I mean, you could have a massive catastrophe or disaster, which means that they have to make huge payouts. But that's the risk that you take sometimes with these things. But for me, I think they're steady and they pay good, steady dividend. Although, obviously, Aviva was told not to pay a dividend this year. So, hey, Legal & General decided to buck the trend and decided to pay dividends, but there we are. But nonetheless, I think these companies will be fine going forward, hopefully. And yeah, we'll see how it goes. So to wrap up, each of these categories vary in terms of the risks, albeit some have more risks than others. As long as you understand how much potential gains you could get because of the type of company they are, then you wouldn't get disappointed. So understanding that a company like McDonald's, for example, which has a market cap of about $133 billion, is unlikely to really be doubling its market cap, or that its revenue, which is currently sitting at around 20 billion, is very unlikely to be doubling it to about 40 billion. If anything, McDonald's has seen its revenue decline from about almost 25 or over 25 billion to about 20 billion within the space of 5 years. So it's not really, you can't really then be expecting a company like that to be a fast grower. It's not growing anywhere. So it's just understanding those little fundamentals, and this is why this metric can really help you to manage your expectation in terms of what you're investing in, what you can expect from the companies you're investing in, and then it then hopefully helps you to keep your portfolio much longer so that you can really achieve pure growth or real growth in the future. Hope you've enjoyed this video, and please remember to like and share and subscribe. Peace.